Hello and welcome to the audio lecture for chapter 3. Okay, so in this particular chapter, slide number 2, we're going to talk a little bit about the income statement and statement of changes in equity. Okay, there are going to be some formulas in this particular chapter that you will need to make sure you record on paper and that you have a clear understanding of how to work those particular formulas when you see them in some of the problems, the financial problems that you're going to be working on. So let's see, when we start talking about the income statement, we want to begin talking about financial accounting. So we know that financial accounting versus the managerial accounting, in the financial accounting you're dealing more with the numbers. Okay. Slide number 3, financial accounting. I just kind of covered over that. There are 4 most important financial statements. 4. I have them listed. The income statement, statement of changes in equity, balance sheet, statement of cash flows. So this chapter talks about or deals with the first 2, the income statement and the statement of changes in equity. Okay? Now, what is it that drives healthcare facilities to provide financial accounting? What drives it? Outsiders. People that come on the outside, that rely on you for services. They come in, they pay for the service, you render the service. The payment portion of it is what we classified as the financial piece. Okay? So slide number 5, one of the questions, I have several questions, but let's just kind of talk about that first. Who are the outsiders? Well, your outsiders are your patients, clients, consumers, individuals, like I said, that are there to purchase the service from you, and in return you provide that service for. Regulations and standards. So when it comes to financial statements, pretty much the legal authority for the form that's used for those financial statements is done through SEC, Securities and Exchange Commission. Okay. Accounting, of course, you know, is based off of the general principles. Okay. And we'll talk about that extra on this next slide. GAAP, GAAP, the General Accepted Accounting Principles. You should remember that from your accounting classes. That's like one of the very first things that you learn in the beginning when you first started getting into accounting, pretty much your accounting 1 class, so that you can know that accounting principles are based off of rules and regulations. We do balance statements, we do cash flow statements, we do them based off of the rules that have been set forth. Okay, so let's go over and look at slide number 12. So, what are the differences between cash versus accrual accounting? Cash accounting, and this chapter right here, this is all just basic accounting concepts. Cash accounting is when an actual cash transaction has taken place. So what do I mean by that? I come to your facility, my copay is $10, I give you $10, you record that $10, it hits the books. Okay? Accrual accounting is when a cash obligation is created. It's a little bit more complicated. It's required by GAAP. Cash obligation says all monies received have to be accounted for. They have to be booked on the books. They have to be recorded on the books. Okay? That's how a lot of individuals get in trouble with taking a lot of cash in, but not all of that cash is recorded. Slide number 13, transaction. Anytime there is an exchange of goods, and this does include cash, we call that a transaction, of course. Once the transaction has been identified or the transaction has been recorded, it also has to be what they call posted. So a transaction is identified, it's recorded, it's posted to an account of some sort. Okay? Which account? It depends on what that transaction is. So the way businesses keep up with their financial statements is they have financial forms that they keep up with. A lot of this is done in an Excel spreadsheet. A lot of it is done on a particular financial form that is set up for balancing statements, cash flows, system. All has to do with the aspects of recording and compiling data when it comes to transactions. Now, anytime you are journaling data, this is where you get into the creation of your financial statement. This is where you start creating your income statement, your balance sheets, your cash flows, because now you have transactions that you can use now to produce those statements. Okay, those transactions could be anything. It could be you're recording revenue, profit, net income. It doesn't matter. But whatever monies you're recording, they help you with creating your statements. And then your financial statements starts turning into reports, notably annual reports. Okay, every year, no matter what, you're looking at your financial statements every year. You're looking at the progression of your finances from year to year to year. You're looking for shifts. You're looking for trends. The income statement, some of the basic things about income statements. Well, a lot of times it may be called something else. You may hear it called statement of operations, statement of activities. You may have even heard it called statement of revenue and expenses. No matter what the name is, anytime you hear those names, we're talking in reference of the income statement. Basically, the income statements tell you what you need to know about the operations of your business and whether or not you are profiting. Okay, that's the sole purpose of income statement. Now, income statement is going to include these three things: revenues, expenses, profits. Revenues, expenses, profit. So let me help you with that. Revenue. Whatever you take in, everything that you take in, that is your revenue. Let me give you an example. So you saw 1,000 patients this month, over the course of this month. You saw 1,000 patients. Well, I just say you saw 500 patients over the course of this month. You took in roughly $85,000. Okay, let's just say you took in $85,000. We're just gonna put a number out there. I know that probably sounds drastic, but we're just gonna put something out there. $85,000 will represent your revenue that you brought in. But out of that $85,000, let's say you had $65,000 in expenses. Okay, expenses are those things, expenses, expenditures, all the same. Those are the things that you had to fork out, pay out. Okay, those were your obligations, both cash and non-cash. You had to spend those out. So let's say that came to $65,000. With bringing in $85,000 and $65,000 going out as expenses, you have $20,000 left. That is your profit. Okay, so I want you to note as one of your formulas, profit. What profit is? What is my profit? Profit is my revenue minus my expenses. You cannot record or you cannot know what your profit is until you have excluded your expenses. $85,000 is not your profit. $85,000 was your revenue. $65,000 is your expense. $20,000 is your profit. And when we talk about profit, I want you to keep in the back of your mind operating income, net income. Okay, so on slide number 18, I kind of put like a little sample up here, show you about Sunnyvale Clinic, and I kind of want to show you about their revenues and what they generated in, what it looks like they had going out, and what was like their net when it came to their revenue. I just kind of put that little slide in there. Okay. Now, Let's look at slide number, let's go to slide number 23. So I want you to look at the difference in expenses for Sunnyvale. They had more expenses going out in what year? 2015. But I want you to look at every single thing that went out. If you notice from 2014 to 2015, each one of those things that are listed up there all increased. Leasing, insurance, supplies, everything increased. Anytime there's an increase in your expenses, there's going to be a decrease in your profit. Okay? So basically, the less you spend out, the more you profit. The more you spend out, the less you profit. What are expenses? Anything that has to be used to help you operate your business is called a expense. Okay? Salaries, supplies, inpatient services, outpatient services, you name it. Any of those things are classified as your expenses. Salaries and benefits, those are expenses, but they represent labor costs when it comes to the financial report. So anytime you are looking at reports, when you're looking at reports and you see labor costs, just know that those are salaries and benefits. That is why when companies get ready to downsize, cut, they always try to start with people that's making the salaries, because they know if they cut those salaries, especially your salary paid people, if you got a person that's making $60,000 a year, they're a salary paid employee, plus you pay the benefits, they look at, oh, okay, not only will we get that back, but now we won't have to pay out benefits. So anytime you see salaries and benefits, know that that's a labor cost. Supply costs, pretty much any material that you have to split out, okay? And I know this is a review, so I'm gonna hurry along. Insurance expenses, that has to do with any type of property and liability insurances or property and liability risk. Okay. I always think about your leasing costs. Slide number 27, your depreciation. Okay. You do have depreciation costs. Every time you buy a car, the moment you take it off the lot, the value depreciates. You may not know that, but the value depreciates the minute you take it off the lot. Okay. 30. This is an example of what an operating income sheet looks like. When we talk about operating income, we're focusing on operating revenues and expenses. Revenues and expenses. So slide number 31, I put you a slide that says revenue minus expenses equals operating income. Make sure you write that formula down. Revenue minus expenses equal operating income. Revenue minus expenses equal operating income. So my operating income, again, slide number 32, revenues and expenses, and you're looking at profitability. You know, am I profiting the way that I should? Okay? Am I spending out too much? Am I spending what I should be spending? Okay, is there some areas I can cut costs? The non-operating income is income that you spent that wasn't related to patient services. Operating income plus total non-operating income equals net income. Net income, slide number 37, is the second measure of profitability. Okay, pretty much we call that the bottom line. So it pretty much helps to measure the total economic profitability. Okay, slide number 39. In a non-profit entity or a non-profit business, their net income is reinvested back into their business. In a non-profit corporation or a non-profit business. In a for-profit business, the net income goes to the owners. So make sure you understand the difference in that now. Not for profit, net income goes back in the business. For profit, net income goes back to the owners. Now, with accrual accounting, slide number 40, with accrual accounting, net income is not representing any type of cash flow. Net income is not representing any type of cash flow. Okay? Now, when it comes to cash flow and how cash flow is determined or how it is calculated, you calculate your cash flow by net income by adding your net income plus your depreciation. Okay? So, with accrual accounting, net income doesn't represent cash flow. But in income statements, your cash flow is represented by net income and depreciation added together. Okay, so look at slide number 42. I put you kind of like a example of there of, and I put in blue, if you can see how the net income and the cash flow works. You see how net income is calculated, okay? But then you also see how the cash flow is calculated. So the cash flow, again, is net income and depreciation mounted together. Everybody should see that on the slide, okay? So slide number 43, I put you another formula out there. Cash flow equals net income plus depreciation. Just so you have that, I want to make sure you have that particular formula in your notes. Statement of changes in equity, slide number 45. Statement of changes in equity is a reconciliation form in the event there is a discrepancy between net income items and what goes on a balance sheet. So you have what you call a statement of changes in equity. Okay? So how does that work in not-for-profit and for-profit? Now, in a not-for-profit organization, not-for-profit, net income goes back to the balance sheet. Because remember, I told you earlier, net income goes back to the business. So net income flows back to the balance sheet. In a for-profit, your net income is going to be reduced, often based on dividends, okay? Because all of that money is not going back to the business. That money goes back to the owners. So part of the net income is going to be reported on the balance sheet, but not as much is going to be reported because it's a for-profit business. Whereas a not-for-profit, all of it would go back to the balance sheet. When you're doing or when you're working formulas dealing with this, you want to make sure that once you get whatever your answer is, it's going to be in a decimal. You need to put it in the form of a percentage. So on slide number 47, I actually gave you the formula that says total margin equals net income divided by total revenue. And I also put that it should be expressed as a percentage, and you do this by multiplying by 100. Okay, so this pretty much concludes the basic concepts for chapter 3 as it relates to income statement and statement of changes in equity. Again, I want to reiterate, making sure that you go through the chapter and read the chapter. Chapter 3 is the first chapter that you're really going to start doing some financial problems. Basically, it's going to be just a general review of the concepts throughout the chapter. So make sure that when you're reading chapter 3, you really go through there and pay attention to a lot of the formulas that the chapter gives you, because in those formulas, they're going to also give you examples that you can use, so that when you start doing your actual financial problems at the end of the chapter, you'll have a much clearer understanding. Okay, so basically, only thing we did in chapter 3 was just kind of talk a little bit about income statement, balance sheet, cash flows. We'll get into all of that again for accounting. And when we get ready to start talking about balance sheet in chapter 4, you're going to be able to better understand how to go back and retrieve those concepts that you learned before, where we can kind of compile and put everything together. Income statement, balance sheets, everything has to make sense when you're actually putting it all together. Okay? So this particular audio will be uploaded to the portal for you to listen to at a later date, in case you were trying to jot down notes and you missed a few of the things that I was talking about. And the printed PowerPoints is going to be loaded in DocSharing for you as well. Thank you.